Good to go. Sweet. Thank you guys for joining on another Wednesday. Almost forgot the day of the week again. Good to see everyone. We're just going to be going over some underwriting stuff. We got a few announcements and things to go over in the meantime. Um, but thank you all for joining. And if you guys have any questions, please throw them in the chat. Introduce yourselves, get to know each other, network, connect. You guys know the whole thing. My contact info is in my name, but I'll pull it up as well in a little bit on the slideshow. Cool. All right, let me share my screen. So this is our Wednesday call. This is hosted by Kevin and myself. Kevin is not in yet, but he should be joining us. And we're just going to look over some underwriting stuff. We do go over broker outreach as well. Good way to find deals, especially where you can, if you're good at connecting with a lot of brokers, having them do legwork for you. Biggest thing with that is just making sure that you can confident close. You know what you're talking about. You can talk to numbers and kind of get an idea of what questions to ask. It really helps with the process. We like to bridge those two things together because I feel like it makes talking a lot easier when you know numbers, gives you a better idea of what you're offering, why you're offering it, and um, I feel like those two work very well hand in hand. Luckily for me, I am a broker, run my own brokerage, which I'll get into as well. But I also love the numbers, and that's just naturally like numbers, right? So I got kind of lucky in that sense. Cool. So, like I said, I run my own brokerage. I'm a broker out here in the lovely Los Angeles, California, for the good and bad, the chaos and all. My brokerage name is Quadriga. That's my website. Feel free to check us out. Our Instagram. Kevin is based out of Florida, runs a commercial team there. Been in real estate for a very long time. Been in sales, done amazing stuff. Actually, found our Florida deal that we recently closed, and I will get into more in a little bit. And yeah, it's a little bit about us. We both have management experience. Obviously, both have real estate experience. Um, and this is a Florida deal that I just mentioned. We are having a webinar tomorrow, 7 p.m. Eastern. That is one of the two links I put in the chat, as you guys will see. It should be the first one, the Zoom. I can actually put it again if you don't have it. This is just an opportunity to come check out why we love this deal, why we chose the deal, what the whole processes look like in regards to where we're up to. And at this point, we have closed. The raise is not done yet. We're just raising still, but this is just a webinar to give people the opportunity to come see how we do it. Anyone interested in investing, this is accredited investors. So if you don't know the difference, we can go over that too at another call. But if you have any questions regarding that, feel free to reach out. Like I said, my contact info is in my name. If you don't know where that is, it's on the Zoom. Put your cursor over my face. You'll see my Instagram and phone number. Call me, text me. I always have my phone with me. And yeah, so you can see some of the numbers, you can see the great returns. I personally visited, walked the property as well as Kevin. Walked every unit actually between the two of us and the other members of our team. Um, a lot of great upside here, and we're really excited. Love for you guys to come just see what we do. If you or anyone you know is interested in investing, feel free to reach out. Um, we know this deal very, very, very well. So, and you guys hopefully should be getting an email with this soon as well. Hopefully get that sent out either today or tomorrow. And then we also have the Fast Pass program. Today is the last day to sign up as it does start tomorrow. This will be the second go around. Had a good part and a big part in the first one. So really excited about that. Got to connect with a lot of great members. Got to kind of see their past, started off, kick it off, get like a very personal relationship with the people involved. And it's a great little tight knit group that allows you to really connect, figure out your lane in the space, which I wish I had when I started. Because I think that's one thing that's very underrated and isn't talked about enough. It's exciting and all once you have the units and you have the ball rolling and you have a team or the systems in place and you kind of plug and play and you know what you're doing. But that first initial breakthrough is difficult and takes time, which in this
Yeah.
space, um, patience is a key, but very easy for it to be overlooked. And I spent a year learning, another year in escrow. So you can imagine how this process has been. But it's worth it every step of the way. Kevin, I don't know if I heard you, do you have anything to add real quick?
Um, Nothing to add so far. I mean, everything you've been saying is spot on. A good way to kind of peel the curtain back on what it looks like to be going out to raise capital on these types of opportunities could be seen by registering to our webinar tomorrow. And Fast Pass is a fantastic opportunity to again get the curtain peeled back at different intervals and understand kind of pillar by pillar how you can get through the process of understanding what the entire life cycle is of a deal from finding it to acquiring it to operating the asset and then reselling it for the appreciation and returning that money to your investors.
Yeah, yeah, great point. And nothing to add to as well with what we're doing with the Zoom for the 120 unit in Florida. Um, Reach out to us about it. Like it's an opportunity where you don't. I'm a firm believer of like doing to learn the game and to learn the business and to see the ins and out. Kevin and I have learned a lot in this process just with this one deal. So excited to see what else we could take away from it as we now start to finish the closing, go into the asset management section of portion of this life cycle. But you kind of get to see but reach out to us to get an idea of like, okay, how do we find a deal? How do we run the numbers on the deal? Like, how do we raise capital on this deal? And if you know people that are interested, obviously, like I mentioned, have to be accredited, which we can go over to and make sure that's all done. Like, it's an opportunity for you to practice pitching as well if you know people, and that just gives you another way. Like, hey, I didn't know you're into this. That's how I kind of started too. Is I would just mention deals to other people in my circle before I found this one and started this with Kevin. Um, so it gives an opportunity to be very hands on, and something along with the fast pass as well. Connecting with other people who are doing deals and getting that close relationship so we can work together. That's a goal. This is definitely a team sport, and you guys will see more of that in our webinar and as you guys go forward in the multifamily journey. Um, Speaking of, here's the team. You'll see us all on the calls throughout the week. In a couple weeks, we do alternate Monday, Wednesdays. Here's our Instagram handles. Feel free to screenshot. I'm sure you guys have seen this, but give us all a follow. It's always appreciated. And then here's the schedule. As you see, we alternate Mondays and Wednesdays. All right. Follow us on YouTube. Has all of the older recordings from activation Zooms in the past to my old Zooms that go over a year and a half. It feels like back at this point. So you'll see a lot of my face if you scroll back. Check us out on Instagram and the WhatsApp group, which I think is very valuable to connect with people as well. Get a lot of our announcements, get an idea of who our future guests are, future topics, get good engagement with the group and get more connection with the leaders of MSC. Also, FastPass, if you do join, has its own WhatsApp group. So that's also very cool where you get to be in the group with other people doing the same thing. Anything to add, Kevin? If not, I have something we could run through real quick.
No, nothing to add.
Cool, cool. So one thing I want to show here, and albeit the numbers may look crazy, but it is LA, so that's why this deal is interesting. Is to go through this Michael Blank calculator, and I'm gonna go over it with as much time as we have, of course, but also keep in mind that this isn't like ours to give away. Like this is licensed. License. A lot of people have it. Um, so I'm sure you guys will be able to either. I'm sure a lot of you have it as well. If not, we can show you where to find it. But just going through this because initially, even for as many deals as I had underwritten up to that point. This does get intimidating if you don't know how to navigate it or just aren't comfortable, don't know where to look for it. Some of the things and some of the components that can definitely adjust and alter your numbers. And I think that's a big component of it as well. Right off the bat, before I jump in and dive into this monster, does anyone have experience with this? Have any like hurdles or obstacles they've had with this calculator or any other underwriting calculator they've used before? Put it in the chat. I'd be happy to help questions specific to what you guys are experiencing. Obviously, makes it much easier and more interactive in that way. But if not, I can just run through this pretty simply, and then I'm sure questions will come up anyway. So put them in the chat, and then I'll keep my eye out. Okay. Simply put, first things first. Starting with the first two lines, I always utilize these three scenarios, and you can make it and name it however you please. It's just whatever setup you have. I always have it as what they told me, what I believe it is, and what it looks like going forward. Kind of how I look at this and divide them. If I need to do more scenarios and whatnot, I go further. I rarely try. Oh, I like it. Okay, I'll get to that question in the chat. But I rarely try to make it more complicated than the three scenarios, just because unless I'm really doing like a big difference, like comparison between two scenarios, I usually keep it to just the three. Ironically, this one is not a assumable, but this deal I'm running is a seller carry. But I can show you how I can run the consumable. Look, this is a sample of a copy I made, so I can play with it a little. And this is where the whole Excel component is also really important with this. I'm going to do this real quick. So let's say one thing that's constant with your assumable loan is the loan amount. So before I get into these two lines, which is the asking price, very straightforward. I can dabble into this assumable loan because the question came up. And to be fair, everything here is fairly straightforward. Remember, everything in blue, you edit. Everything else, don't touch.
So if I may, Ed, I want to start also just with like on this tab of this underwriting sheet, what you're seeing is column by column, an ability to put down the numbers into the sheet that can show multiple scenarios. And so the one on the left, the marketing package, that's basically the raw information you're receiving from the broker or from the seller directly. And then anything beyond that, you can rename those cells at the top. So, it could be your version 1, your deeper dive, your collaborated one, your stress test, however you want to do it. But that gives you the opportunity to create a lot of different scenarios without messing up formulas in the sheet, and then being able to go to a different tab, and with one drop down box you can pick which scenario the rest of the formulas connect to. So as an underwriter, that's a very powerful tool to be able to put together a lot of different ideas without having to start from scratch or having to do a different file or whatever. So go ahead, Ed. Thanks.
Yeah. And I appreciate that. So as you're saying that, here's how I plug in the assumable loan. And like I said, I actually did only stay with changing one cell. Well, you're gonna obviously put the interest rate and stuff, but we'll get to that because it's really that you're gonna have to change anyway, and you're gonna have the flexibility with that. So that's just gonna be based on the quote you get. So in this example, my purchase price is 2.75. And if at any point you guys lose me or you have a question in regards to this, let me know. So if the purchase price is 275, that's my cell F7. I'm subtracting it by my assumable loan amount. So if you tell me, Edward, I have a assumable loan, the current balance is 1.5. Cool, got it. I subtract that amount. So now I know what my down payment is going to be. Okay, so purchase price, down payment, you subtract it. Or sorry, purchase price, loan amount, that's my down payment, right? So far, so good. Then I'm trying to find the percentage. Okay, so what percentage is that down? I just divide it by the purchase price. And if it looks confusing, you guys will see it here on my screen. Purchase price minus loan amount, that's my down payment, divided by my purchase price is my percentage. With that one simple formula, I now have my down payment percentage, which then calculates my down payment amount and then determines my loan amount. I'm done with the assumable loan because I got the loan balance of currently. Now, what's important though is you want to make sure this line is accurate, which is your interest. Because if you tell me, hey, Edward, there's 5 years left on my loan. Okay, cool. How much of it's interest only? 1 year. Cool. So I have 12 months now of interest only, right? And that's not years, that's months. It's important. Huge difference. It really can screw up a deal if you put the wrong amount. And we can go into detail more on the P&L. You guys will see why. And then here you tell me, hey, Edward, I have it at 5%. What's the amortization? 30, sweet. And voila. So any questions, you can always come back to this little clip in the YouTube or ask me. I can give you a scenario of what exactly you're using. Like if there's anything else. Usually you're not gonna have many other components to it and factors. I don't want to go down the rabbit hole too far, but your assumable loan sometimes heavily reflects what your exit strategy is going to be. And then I can show you how that would be adjusted as well. But just for the setup itself, so you know what the deal looks like, this would be what it is. So in this scenario, I have a 12-month interest only and 30-year amortization, 5% interest.
And
I would love to find out. Oh, go ahead, Kevin.
Well, I was gonna say, like, so to the attendee that asked the question about the assumables, like, come to our webinar tomorrow. Like the deal that we're going to be talking about that we bought, we did an assumption. You know, we did a Freddie Mac loan assumption on. So we use these models to buy a $20 million property. So we have an idea of how important it is to refine these numbers to the right level to then go out and talk to investors, to talk to our loan partners, to talk to our KPs, to talk to everybody that we got to put the team together to go out and do this acquisition. So it's a powerful tool.
Mm-hmm.
And this was one of the main underwriting tools that we used up front as we were getting ready to provide an LOI on the property.
And guys, I want to make this really clear too, because the underwriting doesn't stop arguably ever, it feels like. Because you're going to have new information, timelines are going to change, quotes are going to be verified and altered. Your interest only period doesn't stop either, right? If that was 12 months today and you're closing in 3 months, it's not 12 months still. Nobody's freezing time, right? If there's variable, let's not even get open that kind of worms. And tenant renewals, that's another monster. So it's like this is an evolving thing. This isn't set in stone. If you guys saw archive history of underwriting just for this deal, you guys will think we're crazy. Besides the point, it's a lot of underwriting. It's an evolving document. So that was just a little example I wanted to. I saw the question in the chat, and it's early enough in this calculator that it's basically what was going to be adjusted next anyway. So I appreciate you guys for bringing that up because part if you could get stumped right there. Like if you have an assumed loan and you don't know how to put it in and implement it and make sure it's accurate, it gets tricky, right? You're like, okay, where do I go from here? Nothing else matters. Another thing when you are doing the assumed loan, you should have an idea of what those payments are. If not, because remember what the current loan balance is, especially if it's not interest only. If the interest only period has passed or you're not sure if it's passed, you got to make sure you're putting in the correct loan balance, but also keep in mind that what the loan balance is today doesn't mean that's the number that the monthly and the PI were taken off of. Like it's two important, like very different things. what's the original balance, what's the new loan balance, what's the life like. There's a lot more questions that need to be asked than just I have a loan for this much. Of course, Jerry's on here, so if you have any loan questions, you know who to ask. Um, that's it's a lot more than a simple this is the term and that's all I need to know. Jerry, did you want to say something or jump in? I feel like you're looking to unmute.
No, I didn't.
Okay, cool.
I was listening in and out. We got a lot of things going at the house, but I wanted to jump
Yeah,
on.
yeah, for sure.
So I've been,
Yeah, good seeing you as always.
yeah,
Um,
yeah. You too, man. I've just been part way listening, trying to, but
cool, cool.
you know.
Awesome, awesome. Good seeing you. Uh, so now we're got the down payment. If you're going to do an assumable, that's how it's going to look. Interest only. This is important regardless if it's assumable or not, because any new debt you acquire may have this as well. And there's a lot of different components as well with the loan. So you really have to know and be confident that these are the numbers I'm working with. These are the terms. This is what it's going to look like. This is my like. You got to have all that figured out before you can even begin to underwrite. We haven't even touched the numbers of the deal yet, besides the unit count and the purchase price. You know, everything else is like your homework, right? Like you have to bring these pieces to the table. Reserves just depends on what you want to do. The property size obviously is a factor in that. Um, we like to keep it 1,000 a unit. In this case, it's LA. It's a smaller unit count, so I have it at 2. Even that you can argue is not enough, but I have reserves set aside elsewhere as well. In addition to that, estimated closing costs. Remember, you're not going to be adjusting this. Another point that I just noticed as well, if you ever see a cell and you're not sure if you should change it or not, click on it and see what the formula up here says, and that'll show you like, okay, I shouldn't mess with that because it's tied to something else. And this will just show you that, okay, summary, D18, that means if I go to summary, D18, that's where the number came from. Of course, it's never that simple because this is now going to take you somewhere else where this got the number. But I'm not going to go down that rabbit hole. I'm just showing you guys how to interpret this and how to to and not to. Because if you change this number, your whole thing all of a sudden falls apart and you don't know what happened. This could double, triple, quadruple, or eliminate. Gross potential rent. This is important. This is the part that gets really like it's very easy to put the wrong number. With the gross potential rent, you want to that's where knowing your markets can be really important. You want to put what the units would earn today, not what they're receiving on this line, because what they're receiving is not my gross potential rent. That's their current. The gross potential rent, you want to put what you think those units would achieve today based on the market rent and the comps. Then any adjustments you're going to make are going to go on the vacancy and the concessions, lost lease, bad debt. Initially, as Kevin mentioned, you're going to get a lot of that data from the marketing package because I can't guess somebody's vacancy of what they've been operating at the property. And I definitely am not going to try to guess any of their concessions. Like, if you're guessing that stuff, it's already like either the broker's not giving you enough information or you're not asking the right questions. That's first and foremost, because this is the baseline of what a broker should have, or even a seller that's like half managing the property should have that information as well. If not, you'd be able to figure out with the loss to lease. Vacancy and bad debt and concession is a little more tricky to find out. But again, ideally, you're not doing the math and pulling the teeth to get that information. But ironically, if you are the one doing it, those usually come out to be the better deals because less people are willing to take on the headache. So there's that too. Any questions up to this point regarding the rent and the debt? I either lost everyone or I'm really good at covering all my bases.
So one thing I would like to bring up right now is the fact of like when you get information from a broker or from a seller or a marketing package, you need to pay attention to what is the sample of the data. So the gold standard is what we call the T12, the trailing 12-month financial statement or trailing 12-month profit and loss. Some brokers or sellers will try and give you a T3, which is just the last 3 months, or T6, the last 6 months. And that's because if I'm working to increase the rent I'm receiving from a property and I give you only the T3 and then you annualize it, you are now valuing that property higher on behalf of the seller than if you get through T12, where maybe 10 months ago they had to evict half of their people, but they're covering it up by not giving you the full 12-month history. So be very weary as you're doing your underwrites of what the sample of data is. And if you have that seller or that broker that's not giving you all 12 months or even more, which is usually not that common, but always nice to add, then just take all that information with a grain of salt and then kind of discount whatever those numbers are a little bit, because they're probably concealing some improvements they've done.
That's a great point, and I also want to add to that because that doesn't only like that applies to everything Kevin said, but in addition to, you get annual, quarterly, whether it's tax, insurance, XYZ, those payments aren't every month, but you do have to factor that into your expenses. If you just miss that line or don't see it and don't know, hey, like, or notice that it's missing, I should say, like, it's really easy to hide something if you never put the line there. And I'm not saying people may intentionally hide it. Not me, unfortunately, but it's not. Sometimes a broker I've had like, hey, where's the tax line? They're like, oh, sorry, it's at month 5, but they only gave me 3, right? And again, it's asking the question would then be like, hey, what was the tax expense? What was the insurance? What was XYZ that doesn't happen every month, but happens once every quarter or every 6 months, whatever it is? You may completely miss that expense, and then you miss in the annualization of it as well. Or the opposite, you may annualize it when it's only supposed to happen once or twice. There's that too, right? So it's don't just take the information and copy paste it. And I think we had this conversation a couple of weeks ago, last time we talked, of the AI automation. AI is just going to plug and play. They're not going to understand what each line item is and how much it needs to be, whether it's annualized, whatever the case is. Like, that's why it's important to really review the numbers, especially when you look at these lines based on what they're giving you, what it's going to be, and what it is moving forward, because this is where a lot of that it's going to be, is your expenses. We spend a lot of time in these cells because this is evolving as well all the time. Like, until the last minute, you can have a different quote. Whether it's an insurance, whether something happens and all of a sudden taxes go up, ideally down, but that's never the case. Or just other things that after inspection that you notice, like, hey, maybe we do need XYZ now that we didn't think we needed before. Another thing here is the other income. That's one that you want to really understand where that came from. Was additional income from stuff that's more positive, like utilities, rubs, things that are implemented to encourage additional income, or is it a lot of late fees, which, sure, the income's nice, but that's not something you want to deal with either, right? Like, there's a little bit of that balancing act. So you have your gross potential rent. That'll calculate your average monthly rent per unit. You have your vacancies factored in, your concessions, and then your gross potential income, your other income, and your effective gross income. This one may not be the best example because I'm basically having zeros here. But if I want to get very technical with this specific example, it would essentially be this. So that would be it. And then my vacancy would be this minus 14. Well, vacancy was 0, and then this was about negative 80,000. So that's kind of where we're at with this specific property. This is a real life property that I'm actually trying to acquire, so I know the numbers off the top of my head. But it's in LA, so I don't think anyone here is going to care about it or have much interest in it. But yeah, this is what I'm trying to sell off. And then here are the expenses. Again, it's really important to look at the percentages and make sure that these make sense in the area that you're buying. And again, I say this all the time when it comes to market location, every city, state, in between has their own monster, whether it's insurance, property tax, tenant laws, pick your poison, everywhere has something. But in some states, they'll look at this and say, your insurance should be way higher. I agree. I have my own problems with it being California that I have to deal with. And then in Florida, you're like, oh, insurance is way higher, but your tenant is the rules and laws and XYZ is much more favorable. So in every market, these percentages are going to be different. So there is no one rule, like one number or rule of thumb that'll satisfy it all. That's important to understand because I don't use the same numbers or even percentages, even if it's in the same area because of year built, how updated is it? That's going to affect my insurance in Florida. Is there specific construction that's been done or materials used that'll offset some of my insurance quote and the premium and the X's and O's that you're going to have to get into? And yeah, it seems tedious. And this is also why I encourage don't say I'm open or try 7, 8 different markets, because unless you trust and have reliable numbers in each one and you get very accurate information and you can't spread yourself that wide, underwriting each deal in these different markets is just going to take so much time, and not always going to bring any success. And like until you get to a level of, I know that market, I know that area, I have experience of multiple years, then it becomes a lot easier. Like if you give me Texas deal, and I'm plugging in numbers based on what I think the tax might be, I'm going to be way off, like godly amount off. And then I'm gonna be like, oh, this is a great deal. Someone's going to look at me like you're crazy. And then all of a sudden, it's like, okay, what am I really doing? You lose credibility, waste time, you're running in circles. So it's like, what's the point? I was better off not doing it at that point, to be fair. And then you get your lovely NOI. And then when it comes down to the debt service, you can have your interest rate, your amortization, and then the rest will populate itself. This market cap rate, ironically, is fairly important. And I'll show you guys why. But it's important to put this number and understand, and not just put any number, be as accurate as you can be. Obviously, I know this isn't the most easy information to find sometimes. But the reason for this is because this number is going to determine what this number is on the exit cap rate. And that's, again, another situation where if you're curious where this number came from, just look at the formula. The best advice I can give. If you're not sure where something is, go down the rabbit hole, find the formula, see where it came from, what it's multiplied by, what other cells it has a relationship with, and that'll help you understand why that number is what it is. How come my cap rate here is 0.13 more than my scenarios have where it's at 4? I didn't put that 413, but that was automatically generated here because it's in my variables tab right here. I didn't know about this for so long using this calculator. I was like, oh, that's a neat feature. I used to change it myself. I didn't know. I was just like, I'm gonna change it, whatever. So don't always change it. Don't do my route because then you get broken calculators.
And
see
why
how
do we do the bump?
Yeah, that's a great question too. So the bump is there for 2 primary reasons. We don't know what's going to happen with the market tomorrow, yet alone when we're going to exit in 5 years. That's the biggest reason. But the second one is, if I don't know, I'd rather be safe than sorry. Because the cap rate, the bump is there to, if I sell it at 4, but I project it for 4.5, let's say, I'm winning. I'm happy. Right? I sold it for more than I projected. So no investor is ever going to be upset at you for making them more money. I absolutely promise and guarantee. And if they are upset at you, give me that extra money and say, hey, this is what you get. It's the reality of it, right? Or you keep it, whatever, you deserve it. But if you project it for 4 and you sell at 5, and all of a sudden your investor is looking at you like, where's the rest of the money you promised? Because in their mind, look, we don't promise anyone anything. We say this is what we're projecting. The day comes, they forget the word projecting and say, you told me and promised me this. It's the reality of it. Obviously, your relationship is going to have a lot to do with that. But at the end of the day, you never want to overpromise. You want to overdeliver. And this is how you overdeliver, by putting in fail-safe if this actually does happen. And if it doesn't, even better. Hey, I got you another percent on the cap, which in hindsight makes a very big difference. And the more you guys play with this, the more you'll see that. But there's a lot of different places in this calculator that we've put like fail safe, extra bump here, extra bump there, where in that one scenario, one specific doesn't make a big difference, but in the grand scheme of things, it makes a massive difference when you add it all up. And that's how good deals turn into great deals, and investors will love you forever.
Yeah, it's important to remember that when you deal with these complicated opportunities, these spreadsheets have so many little variables that if you have if you have a compromise type of operator that just wants to underwrite a deal to make it look good, they've got plenty of places to make it look good. And so as an educated, sophisticated investor, it's important to look through the underwriting of any deal that you're going to invest in or represent and understand how they came to all of these conclusions. So if you see an exit cap rate that is lower than what you're buying at, you got to really ask, why do you think that's going to happen? And so that's just goes back into the better safe than sorry. Let's assume that we're going to sell it for a higher cap rate. It's still going to go up in value because we're doing a value add to the property. So yes, it's not going to maybe double, but something less than that, etc. So you have to be able to understand the logic behind the spreadsheet and not just take the numbers as, oh wow, these guys spent all their time putting these numbers together, so it must be right.
I love what you said there, because one thing I want to reiterate as well is, if you need something to happen that you don't have control over to make a deal, run. Because I don't control the cap rate. I don't know what's going to happen. I don't control interest rates. So if interest rates are higher than they are today, I'm not, it's just math, or economics, I should say. You're not going to be happy with the cap rate you're selling at. But I don't control that. It'd be fantastic if I could control that. That'd be amazing. I don't. Just the reality of it. What I can control is rent, improvements, management, operations. I can control all that. So I'm not going to factor into my equation of this deal makes sense because of the one thing I don't have control. 2 or 3 things I don't have control over. I can't control our insurance quote, unfortunately. I would love to be able to do that. I'm sure Kevin would too. I'd love to control a lot of things in California that I definitely can't control, but that's another story for another day. So that's what I love about this calculator. It shows you, okay, these are the things I can control. That's cool. And even that you might not be able to fully control, unfortunately. But these are the things I can't control. Let me just make sure I'm being super safe. And in 5 years, my investors will thank me and I'll thank myself. Remember, you're invested in this too, right? So I think that's a big way to look at it. I know I feel like we're spending a lot of time on this, but that's literally what our whole thing is like the underwriting part of it. And these are all great questions to ask brokers as well, which is why I like tying the two together, and getting thoughts from 2 brokers, which also helps. But these are what we look for, and obviously we can go through this fast, but I don't think it's going to help anyone. I like this pace. I like the fact that you guys can ask questions where you need it. And obviously, if I go any faster, I'm just going to get distracted and bounce around. So we want to avoid that too. So scenarios real quick, that just goes over everything. One last thing I want to say on this tab: your marketing package, your version, and projected, your expenses should never be the same across the board like it is in my example. My example is unique because of the situation and why and how I'm buying it. I'm putting all of my current, what my expenses and what my numbers are going to be, and I'm very good friends with the seller, so it's a very different scenario. But this should definitely not be the case, because I can guarantee you this is also not what his numbers are. His expenses are a lot lower. Okay? So whoever you're buying it from, day one, you're going to increase the tax. Just naturally, that's kind of what I always gravitate towards. Because I'm trained in California, you can get reassessed the day of purchase. Now, is it the same everywhere? Of course not. And which is why I say, if it's different somewhere else, I don't know. I'm not going to guess. I'm just going to take what I know. So day one, my taxes shoot up. Insurance, probably going to go up too. But I would never underwrite a deal day one of what they have and it's going to look like, because that's already going to be different, because you're going to probably change management. Or if they never had a management company, you already added a cost that they didn't ever have. And now all of a sudden you're like, oh, I'm up 4 to 10% or whatever it is. So keep that in mind as well. Those are two big things, because you can make improvement on expenses, but if you don't put in what's already there, then what's the point? The summaries, the summary tab. This is where you just go through, make sure this all looks right, and hopefully, and usually does. And remember, you can always change the scenario, which I like as well, because then I'll just take whichever scenario that you had you're looking at the moment. Make sure you check that, because if not, you're going to be talking about the wrong one scenario, and that's not fun. And then here's the important part of the returns. Obviously, like I said, this has been played with and messed with, so don't worry about the numbers too much. And that has also a lot to do with the assumable numbers I plugged in. But your summary here is really what's important in regards to what your returns are going to look like, where the numbers come in, how the numbers are calculated, and what it looks like year one, which is a lot of people care about. And that is important to know what your numbers are going to look like year one, what you're getting into. This is also important because the member equity is how you're going to do the splits. A lot of times you'll hear 75-25, 70-30, 80-20, whatever it is. This is how it's calculated, because 100% isn't always going to the members. You have the management, that's the GP team. Okay, so keep that in mind. And then obviously you're going to have potential other stuff like asset management fee, perhaps you're going to plug into this transaction fee, and then your acquisition fees. So these are all just other expenses that they don't take away from the deal, but they take away from the returns. Two very different things. The deal is, this is what the numbers are as a whole, but there's a lot of different ways that get split up. You have the GPLP splits, you have operating costs, obviously you have your expenses, you have your debt, and then you have what it takes for the GP team to operate. That's a big component of it. Until you've done the deal, been through it, and even put the systems in place, you don't realize how many costs come with that as well. That's a big component of this equation. There's travel that comes into this equation. And yeah, would the investors love for us to just put it out of pocket and say, figure it out? Sure. But also, your returns don't come unless we're hands-on. Like, that's where all factors in, right? And that's one of those things where until you do it, you don't really see that side of the whole GP and management and the running around and fun stuff. So keep that in mind. That's why you have the fees that you do, the asset management and the acquisition and whatnot, and make sure that's very clear. This is, I feel like, a very important line that is easy to overlook because it sometimes gets hidden, is how much money do we really need in total? Like, I know the down payment, I know what some of my costs and fees and the X's and O's and closing costs are, but how much do I really need in the grand scheme of things? This will help you, because this is your kind of reference point to where these returns are based off of, is your capital. P&L, again, this one is where you get really tricky with it. Personally, this is specific to my area, so don't worry about that too much. And this is also us playing catch up. But you want to make sure that when you're doing the yearly increases on the rent side, it makes sense. And also, again, knowing your market. California, very different monster than Florida, which is a different monster from Texas, right? So just be careful with that. Expenses, as much as we'd love for them to stay flat, never do. It's the reality of it. And if you don't prepare for that, you're not gonna be ready for any big bills or anything like that come up, or any sudden changes in tax. Also knowing when stuff is reassessed, if it is reassessed, that's big, because that happens different times and it's scheduled differently in every state, city, sometimes county, right? Replacement reserves, that's always important because at the end of the day, you have we own stuff that are being used and abused sometimes and have a life of their own. There's the depreciation cost tag. I'm not getting into that today. Although I think we might be soon, maybe we'll talk more about that.
Yeah, MFC will be talking about it, but probably during the Monday, the activations or the activation Zooms. But while I've got the mic, I do want to point out that the escalators are important, but like as Ed was talking about with taxes, so you always want to verify whatever county or state, usually county level, you're buying a property in. You want to see what the tax increases are capped at. It's usually going to be different than what you're putting in for your assumptions. And taxes being such a big number these days on these multi-million-dollar properties, it's very important to sometimes take the time to manually go in and, say like for South Florida, we could see 5% per year, but maybe your expenses escalate at 3. So you're going to want to go in on that row in the spreadsheet and manually give it that 5% bump every year, and take the time for the minutia, because otherwise you're going to spend months explaining to people why your underwriting was not accurate.
And remember, uncontrollable. You can't run from that tax bill, unfortunately. So no surprises. And then the acquisition cost, this one's a little more tricky, and again, very specific to the property, how you're acquiring it, assumable debt, new debt, how the taxes and the insurance stuff is going to work. This is very specific to the deal, but it's important to keep in mind that this does affect your calculation. So make sure you take a look at it, and then go through each one of these. Yes, you do need to pay this for sure, and this, and this, and so on and so forth. So keep that in mind. Even if you don't purchase it, getting the contract moving forward, going through inspections, you'll have those costs as well. So just be aware of that.
And the escrows are important too on this tab, as you guys are using your calculations for closing costs, which is what the acquisition cost is relating to, because your budget might include a pro forma annual tax bill, or sorry, insurance bill, but what do you have to do before closing? You have to pay your insurance premium. So you need to have that money up front as a closing cost and accounted for, and not thinking, oh, I'll pay my insurance bill a few months down the road when it expires or whatever. Because whatever the seller has, that's their policy, and you got to get your policy up and running day one.
So that's fun. Exit strategy, this one is very deal specific. There's a lot of ways to make this, play this out depending on what type of acquisition you're doing. You do have a cash out refinance option, which I can play with this tab a little bit just to show you guys how it looks. The refinance LTV is important because that's going to affect what your new debt is. Interest rate, obviously, that's the hardest thing to predict, especially if you're doing 5 years out. I don't know what's going to be tomorrow, yet alone then. So kind of, I don't know, ballpark it and kind of see what you think it is today. Same with the cap rate, add a buffer on top and see if it still makes sense. If not, then, well, if it's worse, what do you think is going to happen? That's how I look at it. Also, what it's going to do is you have your cost with it. Obviously, there's a cost of refinancing, and also tell you, is this even realistic based on how much loan and debt you're still going to have? And a lot of this is the value is based off of your NOI at that point. And then again, it'll factor the cap rate. Okay. Now, the exit strategy, you're going to have your sales cost. You're going to have your outstanding loan balance, which is calculated by the loan that we painted in the scenario here, whether it's assumable or not. That'll reflect here. Show you all the money you've made up to that point in rent and income and whatnot, and then factor into what you sell for, pay everyone back, give you a total number, punch out your returns, and then from there it shows you the breakdown of the deal. So the exit strategy tab is important because you want to make sure that this makes sense. Don't tell people 10 years or 5 years and underwrite it different. That's just going to throw things off. Also, don't force a deal because at year 4, it may look better than if I did it at year 5. But if 4 years isn't realistic, don't put 4 years. That's a big part too. It's easy to manipulate this to make it look like the numbers work, but does it actually work? And is that realistic? Or are two very different questions. Okay. So that's important. That's really important to keep in mind, because there's a lot of ways on this calculator, especially for me to tweak things or move things around and say, oh, but what if we did this? And it's like, okay, but is that realistic? Can I actually do that? Am I allowed to do that? Does it make sense to do that? And then what's that going to cost? Which almost everything has a cost, obviously. And then from there say, okay, cool, this looks good. We can go from there. I think that's a big thing with this calculator. Don't make it look good. If anything, one thing I've been told a lot, and I agree and believe in, is when you're underwriting a deal and you find out, like you see, okay, this works, good. Now find every way to kill it. Whether it's through this, beating it up, cap rate buffers, making sure, like realistically saying, okay, if this happens, it's always still good. If that happens, always still good. If it doesn't happen, always still good, which is a factor as well. Once all that stuff is kind of vetted, then you know you have a good deal, and that's why they don't come as often. I'm always concerned if someone's like, I have 100 good deals. I'm like, cool, how many did it take you to find that? 100. No, no one's hit rate is that good. Or you're just lucky. I don't know what to say. Pick 6 number random lottery numbers for me, please. I beg you. And then the return tab will really break it down. One cool thing here is that you have the members return based on specific investment. That's a fun tab. So you really get an idea of like, hey, I have a cousin, relative, friend, some guy I met at a networking event that wants to invest X amount. How can I see the returns and paint them a pretty nice clean sheet and picture with how that looks? And then remember, guys, as well, and we'll get into it more when we have that guest, but the cost of depreciation is not factored into any of this. We just consider that a bonus, which is nice. And like I said, the variables tab, just make sure you're aware of this. Other than that, I think I've gone through it. I know at the end we kind of sped up, but is there any questions?
Go back to returns tab real quick. So let's start from the top. So each of these blocks is very important in its own respect because it's different. It's a different data set. So at the top, you've got your project cash flows, which shows the member cash flows and returns, which is going to be very similar to what was down below. And then your projected manager cash flows and returns, which is the GP team and what they might be able to be bringing in through all the sweat equity and managing of the asset. Then the summary is the deal. Like if you were just deep pockets buying this property for yourself, you know, that's what the deal would look like if you didn't have to do a syndication. And it helps you when you do more and more properties in the spreadsheet, you start to see, you know, the trend that the deals that are going to make sense as a syndication are just deals that would have been a deal to an individual investor because there's enough margin available to allow a management team to take care of everything for the limited partners. And that member return at the bottom, that's a live and die calculator, because there's a blue cell there. Ed, if you can go back down to the investment amount. So there's a blue cell there that allows you to be able, when an investor asks you, hey, I've got $320,000, what does that look like for me? Ed can put in $320,000 and then take a little screenshot and give it to them and say, you know what, in reality, so on this calculator, $320,000 after year 5, should be able to turn into a $800,000 return to you. Does that sound pretty good? And it gets that conversation moving, where you can give people these accurate projections, without having to kind of beat around the bush or make any other assumptions.
Yeah, definitely. And like I said, this is us just kind of going through this. I'm sure there's gonna be questions about it, or we can tackle those as well next time. But we are over our time. But I do appreciate everyone for sticking around. If anyone does have any last minute questions, please put in the chat. If not, this recording will be on YouTube, like I mentioned. As I said earlier, we do have our Zoom tomorrow. If you guys can make it, that'd be great. I'm gonna put the link in the chat again, and then also check out the Fast Pass.
And if I may, so there was a comment that was about the 5% cash on cash being low. So I want to go ahead and just kind of go out on that one. One thing to bear in mind is that a majority of investors are not going to care about just cash on cash return. You got to look at all of the different KPIs of a deal and understand, as an investor, what is your true desire from a deal? Is it wealth preservation, which is more of cash flow concern and cash on cash return concern? And then is it about wealth generation? And which I believe this spreadsheet is really basing off of a wealth generation investor, because it's talking about a large return through the appreciation of the property and the value add done during the hold. The cash flow is great. You're getting a 5% return, so you're at least making money every year. But the big money is by putting the money in and knowing 5 years later you're going to get 800 for 320. So it's important to realize who you're talking to, and you might be at an event talking to an investor, and they say, that they just want to make sure that the money they have can get them through retirement. They're probably going to want to lean more towards these high cash on cash return deals. And many of them, because of either a higher pref or whatever, end up having a lower IRR and a lower annualized average return, because all of the returns they got was just through the cash flow versus any appreciation. So I just want to interject.
Yeah, definitely. And then also keep in mind, every investor is gonna be different. You're gonna have a lot of different approaches and strategies. This isn't a one size fits all. It's really, hey, here's the opportunity, and at that point, if you believe if you believe it's a good deal, all you can do is present it as such, and from there, the opportunity's out there. On that note, if you guys want to hear more about that, see you all tomorrow. We'll be there. Also check out the Fast Pass. I put the link again in the chat. You guys, looking forward to seeing you guys on there. It's gonna be fun. We'll be on the calls. And please reach out with any questions. And I will see you all soon. Have a great night. Take care. And if you guys want to connect, reach out. You guys know where to find us. Thanks.